It's just buy it and hold it. But firstly, you have to deal with your own psychology. I'm down, I'm up, I FOMO, my friend made 100x, all of this shit, right? You need to stop all of that. And then you need to not use leverage. Because if the game is to hold onto your tokens from $2 trillion to $10 trillion to $200 trillion when it's a full mature asset class, the game is to keep hold of your tokens. Don't give anybody an attack vector to take your tokens off you.
Yep.
Which is why if you can self-custody, better. Certainly don't borrow against it because somebody will take your tokens. It's just like, don't do dumb shit when given the biggest opportunity of all time.
In the past few weeks, as the cryptocurrency bull market has surged, Real Vision CEO Raoul Pal has consistently delivered a straightforward message to investors: don't mess this up, though his language may be more colorful. Pal's warning about the perils of leverage and FOMO has been crystal clear. He emphasizes that attempting to amplify returns through these means can lead to significant losses, especially in the volatile cryptocurrency market, particularly for newcomers still navigating its complexities. In a recent post, Pal reinforces the importance of patience, strategic planning, and avoiding hasty decisions to maximize gains during the bull market. He underscores the role of market downturns in creating opportunities, advocating for a long-term buy-and-hold strategy and adding to positions during bear markets to compound returns. Pal's signature phrase, "all we have to do is not mess this up," encapsulates his message. During a recent interview with Stephen Rust, the Real Vision CEO and former Goldman Sachs executive reiterated these warnings, sharing a personal anecdote illustrating the pitfalls of leverage in a volatile market. Pal stressed that while leverage can wipe out investments, holding on to tokens can potentially yield significant returns, especially as the cryptocurrency market matures into a multi-trillion-dollar asset class in the coming years. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
This is the biggest macro trade of all time. It's the best performing asset class in all history in the shortest period of time. Right? So you've got the gift. I don't want to hear anybody say we've been shut out, because everybody can put 10% in. Everybody. Right? If you live in the Philippines or you live in Nigeria or you live in New York City, you can put 10% of your wages in. Right? So this is an egalitarian, democratic, global, homogenous asset class.
Yeah.
And it is the biggest trending asset class of all time.
Yeah.
So given that, it's pretty easy. It's just buy it and hold it. But firstly, you have to deal with your own psychology. I'm down, I'm up, I FOMO, my friend made 100x, all of this shit, right? You need to stop all of that. And then you need to not use leverage. If the bloody asset class is going to go up another 100x from here, you honestly don't need to use leverage. You don't need to spend your whole time looking for the next 100x token and stick all your money and hopes and dreams in that. Just put 90% in the main asset classes and it'll do fine. You know, a bunch of it is degens, like, I'm just going to get a 5x leverage, whatever, get washed out. And most of them are not putting their life savings. They're just trading. There's also a bunch of hedge funds, short-term people. There's market makers. There's all sorts of participants. But actually, crypto markets aren't that deep.
Yeah.
What's also good is they're quite Austrian in how they work, because, the creative destruction cycle is all the time there, right? Because the margin gets called immediately. There's no negotiation. It just gets called and you're stopped out and it's done.
Right. Yeah. It's
the only thing we get with it where it wrong was when there's hidden leverage. And I've learned this in the past, is when you go around and ask everybody who's your biggest client, if it's all the same person, then you've got a problem, particularly if they're using leverage. Long-term capital management was the classic example of that. I was on a stag weekend in Kilkenny, Ireland, and I was at NatWest at the time running the equity derivative desk. And a bunch of my friends were in equity derivatives and fixed income derivatives. And we were just having a few beers and the conversation comes up, who's your biggest client? Long-term capital. How much have you got? Oh, $1.5 billion in equity derivatives. I'm like, okay, what have you got? Oh, we've got, $1 billion. We had like $3 billion because clearly I was a better salesman. So obviously we had bigger positions. But then we went around, there's like, okay, we've got just between us lot on the boat, of which 4 or 5 people, we had maybe in equity derivatives alone, we probably had 5 times the value of the fund. I'm like, interesting. Then I spoke to a friend of mine who was the head of Bund trading at Deutsche Bank.
Yeah.
I'm like, how much you got? Goes, 50 billion. I'm like, holy shit. I went back to the risk manager on the Monday morning, hungover and tired, and said, listen, we've got to get out of this stuff. This is a disaster. But it happened again. It was actually Three Arrows Capital.
Yeah.
None of us knew it. All of the C5 projects had one client that was providing all the liquidity. And then when that client went, it all went. And we couldn't see that on chain. Is one of the problems of this market is there's very little secondary market professional liquidity. We have a bunch of trading shops.
Yep.
That's it. The rest is retail investors. The hedge fund industry in the entire crypto space is $5 billion. In traditional markets, it's 5 trillion. So we just don't have depth of market. So if you think what happened with Luna, once you start teasing apart who was trying to spoof whom, who was trying to bankrupt whom, between Binance, FTX, Luna, Three Arrows,
it's like,
it's because there's not much capital in the space. So it's actually capital starved, which is great because it means the returns are very high, but not great because it means volatility is insane.
Over the past year, Real Vision CEO and co-founder Raoul Pal has been emphasizing another crucial piece of advice for investors: how to stay ahead in what he terms the fourth industrial revolution, or the exponential age. Pal articulated his recognition of this new era when he noticed several key trends. Firstly, central banks worldwide are engaging in unprecedented money printing, leading to inflated asset prices that resemble a bubble. However, Pal contends that none of the technologies driving this surge are actually in a bubble. Rather, it appears so due to the significant depreciation of the dollar. Drawing from these observations, Pal concludes that the valuations of technologies will continue to soar exponentially in the coming years. As a former Goldman Sachs executive, he predicts that we have a mere 6 years left before witnessing an exponential explosion in asset prices, particularly in cryptocurrencies and technology stocks. Here are additional insights from the interview.
How I'm thinking this through is, we talked about this is the biggest macro trade of all time. We're still in the middle of it. So great, focus. Yes, you should be involved in technology. You should be investing, if even just to learn, right? Because the biggest change to mankind and society is underway. And crypto is just a part of it. That's just like the transaction, storage, value layer of the internet. That's just a part of the whole story. The bigger things are AI, robotics, genetic science, what that all unlocks, and energy. And this formula that I talk about is the GDP formula. GDP formula is basically population growth plus productivity growth plus debt growth. Right? We stopped and blew up all debt growth in 2008. All debt growth now is just servicing of old debts. So really, the global economy, and particularly the developed world, has slowed down trend rate of GDP growth. Why? Because we've got an old, slow-growing population, and in many countries now shrinking. Italy, Japan, South Korea, Taiwan. I mean, they're all starting to shrink now. Okay, so you've got lower population growth supporting this large debt. So there's not enough money to pay for the debt, which is why the central banks print stuff. But over time, you need to change that equation. Because if not, we're not going to blow up, because for us to blow up, which is what everybody fears, the value of collateral has to go down a lot, which is what happened in 2008. But we've learned this new trick: debase the currency and optically the collateral goes up, right? You cannot go bust in that environment. Nice. Well, not on a societal level. So, okay, how the hell do we get out of this quagmire? Slow growth, aging population. And the answer is, well, firstly, population growth. But nobody wants to open immigration because wages haven't gone up in real terms. So the more immigrants, the less money there is to share in the economic pie. So people are like, no, we don't want that. So then comes AI. AI is infinite human knowledge. And it's going to get cheaper and cheaper and cheaper until it's water. So you scale knowledge at zero cost, which is the human brain, and above that, because that's where we're going. And then you've got the robots, which scales physical humans. So now we have infinite humans at an exponentially decreasing cost. Next, productivity. Productivity is basically the output per kilojoule of energy.
Yeah.
If I look at UK electricity prices of the last 50 years, they're pretty stable. Sure, they're cyclical, but they're pretty stable.
Yeah.
So with EV technologies, geothermal, wind, all of the stuff that we're working on, we know that they don't scale enough yet, storage problems, other stuff, but we know they're going exponentially lower in price and they're rising in output. And then we've got nuclear and what we can do with nuclear technology. So we are going to halve and maybe halve again the cost of electricity in the next 10, 15 years. What is that going to do? Well, think of productivity. If technology goes down half, productivity's doubled. If it goes down half again, productivity's tripled.
Yeah.
So you're going to triple productivity while introducing infinite population. So what I'm suggesting is you have 6 years to make as much money as you can because you have no understanding what the world is going to look like.
Meanwhile, BlackRock, the world's largest asset management firm, is significantly expanding its involvement in Bitcoin. According to a filing with the U.S. Securities and Exchange Commission dated March 7, BlackRock intends to purchase spot Bitcoin ETFs for its Global Allocation Fund. This fund, which allocates investments across equities, debt, and money market securities, manages approximately $17.8 billion in assets. As per the filing, the Global Allocation Fund may acquire BlackRock's IBIT and other spot Bitcoin ETFs listed on national securities exchanges. Recently, BlackRock also submitted a similar filing update for its Strategic Income Opportunities Fund, indicating plans to purchase spot Bitcoin ETFs in the coming weeks and months. It's anticipated that more of BlackRock's multi-billion-dollar funds will follow suit, integrating Bitcoin for enhanced portfolio diversification. What are your reflections on Powell's video and BlackRock's notably bullish SEC filings? Feel free to share your thoughts and observations in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.